a very important week ahead of us as 4 central banks unveil their latest policy decisions. The biggest one is likely to be the US Federal Reserve. The Federal Open Markets Committee's latest meeting concludes on Wednesday the 18th of September, and economists seem pretty convinced the US Central Bank is going to cut headline borrowing costs. As I sit here, the CME FedWatch tool, which you can follow for free for yourselves on the internet, shows markets are pricing in roughly a 95% chance of a 1/4 point cut to 2% and a 5% chance of no change. A reduction would be the second cut this year after July's loosening of policy, and that was the Fed's first cut in a decade. Now, investors still have to ask themselves why the Fed would cut when unemployment is near 50-year lows, wage growth is above 3%, and the US economy grew at 2% year on year in the second quarter. Now, it may be down to pressure from President Trump, or concerns over a stubbornly strong dollar, or inflation that won't quite meet the Fed's 2% target, or worries over global growth amid talk of tariffs and weak trade flows, or, perhaps most importantly, a softening in key economic data in America, such as purchasing managers' indices, industrial production, and possibly even jobs. So leading, concurrent, and now lagging indicators are all looking a bit less strong than they were. The non-farm payrolls number on Friday the 6th of September not only undershot expectations with a figure of 130,000 additions in August, but the July and June numbers were revised down. And as we've discussed here before, you tend to see downward revisions to the initial job estimates when the economy is weakening and upward ones when it's gathering pace. So this may not be a great sign if history is any guide. We can see here the net upward or downward revision to the initial non-farm payrolls estimate number since January 2017. Note how the trend has switched from upgrades last year to downgrades this one. Now, besides the latest policy move on interest rates, economists and investors will be looking for 2 more signals from the Fed. First, any forward guidance on the future trajectory of interest rates. Markets are currently pricing in an 82% chance of at least one more cut down to 1.75% by the time of the last Fed meeting of the year on 11th of December. Second, any news on quantitative easing or QE. The Fed has already announced that it would stop reducing QE by $50 billion a month in September to leave its balance sheet at around the $3.6 to $3.7 trillion mark, way up from the $800 billion at which the program started just over a decade ago. There's no indication the central bank is likely to increase the scheme again yet. Now, the day after the Fed, Thursday the 19th, 3 more central banks will have their say on their monetary policy. The Bank of England, where the headline interest rate is 0.75% and QE has been on hold at £445 billion for over a year. The Bank of Japan, where the headline interest rate is minus 0.1% and QE is still running full tilt to 80 trillion yen a year, or £608 billion. And the Swiss National Bank, where the headline interest rate is minus 0.75% and QE has seen the central bank's assets balloon by more than tenfold over the last decade. None of the trio is forecast to make any adjustments next week, but we shall see if they make any noises about doing so soon, as perhaps they take their lead from the Fed. Company-wise, we have a busy week coming up as well, with a good selection of large and mid-cap firms either releasing results, posting a trading update, or hosting either an annual general meeting or an analysts' day. They include takeover target Cobham with its EGM on Monday the 16th of September, Ocado on the 17th, B&Q and Screwfix owner Kingfisher and also Games Workshop on the 18th, so a busy day for retail, Smiths Group, Johnson Matthey and Auto Trader on the 19th, and Investec, the financial services group, on Friday the 20th of September. But for me, the stock most likely to cause a big fuss in the week ahead is fashion retailer Next. The FTSE 100 member is set to release its interim results to the end of July on Thursday the 19th of September. As we can see here, the shares have had a pretty good run since spring, and they're up over where compared to where they were 12 months ago, even if they've some way to get back to their all-time highs of around £80 a share that they reached in late 2015. Now, this recent run's been fueled by a good streak of upside surprises to profit forecasts and bumper cash returns in the form of dividends and share buybacks, of which more in a moment. July's second quarter trading statement was better than expected. Full year like-for-like sales rose by 6%, as first half full price sales rose 4.3% year on year. As a result, Chief Executive Lord Simon Wolfson raised guidance for the year, whereby for the full period to July next year, full price sales are expected to rise 3.6% year on year. Pre-tax profits are expected to reach £725 million, a fraction up on last year, and earnings per share are expected to grow by some 5.2% to around 458 pence a share, helped by the lower share count that results from the ongoing share buyback scheme. As a result, extrapolating from those pointers for these interim figures, pre-tax profit is likely to come in flattish against £311 million a year ago. Earnings per share will rise slightly, and analysts will also be checking whether there are any more changes to guidance for sales, pre-tax profit and earnings per share before they move on to the dividend and those share buybacks. For the full year, analysts are looking for a 2.7% increase in the dividend to 169.4p, so they'll be looking for a similar increment at the first half stage against last year's 55 pence a share. Now, in terms of the buybacks, Next spent £325 million on buybacks last year, added to £216 million in dividends for a total cash return of £541 million. Now, over the last decade, Next has returned £4.8 billion of what it terms excess cash to shareholders once it's paid its bills and made what it views as the necessary investments in its business to stay competitive. That is nearly 60% of the current market cap. Thank you for watching, and I look forward to seeing you next time.